So the years of plowing money into companies and saying just go for market share and market share is everything. It feels like those days are over. And at some point in time, when the music stops and there's no new capital to deploy into these companies, are you able to still run your company, and are you able to grow and become profitable? I think COVID-19 will accelerate those discussions. Okay.
Hey.
Oh no, you've been contacting. Oh no.
Got you. Welcome to Coffee and Conversations. I'm your host, Karim Rafa. I'm joined today with Michael Lintz, partner at Golden Gate VC. Mike, thanks so much for coming on today.
Thank you.
As I'm sure you know, COVID-19 has taken the world by storm. We're hitting historic lows on equities, on oil prices, and it's a very interesting time to be in a space like yours as a VC, where you have to, on one hand, raise capital, but also invest it. How do you find yourself doing these things right about now?
Yeah, it's a good question. I'll take one step back and kind of explain how a venture capital firm works. So as you mentioned, we have to invest capital. So we invest our capital into upcoming portfolio companies, typically technology startups. But we also have a big set of clients we call limited partners. Limited partners provide venture capital funds with capital to deploy into these up-and-coming portfolio companies. And these are long-term investors, typically over 10 years' time.
So they have to choose to give you your capital as opposed to invest it on the stock market and traditional equities. How's the appetite for that in a time like now when it's really a crisis? Is it easier or harder for you to be in venture capital than, say, in equities?
So typically, those larger institutional investors would invest across different asset classes, where venture capital is actually one part of their, I would say, asset mix. So they would typically invest in stocks, bonds. They would have private equity investments. They would have venture capital investments. Noted that venture capital would be one of their most risky investments that they would hold in their asset mix. So in terms of kind of making a choice whether to deploy capital, depends on how much of a long-term vision do they have. Some investors want to be way more liquid and want to go in and out and be able to take the money out on a monthly basis. You know that venture capital doesn't work for those types of investors. There are investors, sovereign wealth funds, larger family offices that have this long 7 to 8, 10-year horizon. They tend to be more patient, and those are the ones that are investing. In an environment like this, it does change the fundraising dynamic. People are looking at, okay, what is my short-term risk? How much liquidity do we have? How much risk am I taking? With all the uncertainty, people tend to be more liquid or want to be more liquid. So it means that we have to tell them a really good story and really convince them on, what are the opportunities that you invest in. And although the downturn, the difficult times now, where can we still find good opportunities to keep investing in?
As a provider of riskier investments, as you said, is it easier for you to pitch investors now and convince them to invest with you when everything else is drastically falling, or is it harder?
We do see it as a very important part of our job. And I see two ways of fundraising. The one way is convincing new investors to come on board, and I'll talk a little bit more about it later. But we're also having a large portion of existing investors that we work with that co-invest with us into certain deals or re-up in our new funds. It's very important to kind of maintain and work on those existing relationships, just to make sure that they have the confidence that even through periods like this, that we're able to have a very consistent investment strategy, that we're taking measures, that we're mitigating risk. So it's very important to manage that relationship. And that also trickles down to our new investors that will talk to our existing investors and ask, how are these managers investing? How are they mitigating risk? How are they managing their portfolio?
So maintaining this relationship with existing investors is a core part of your job, but how do you scout for new ones?
Funds that invest in VC funds or VC firms are typical. So they tend to be larger institutions. You can talk through, for instance, we see opportunities in the logistics space, or we see opportunities in digital health. So the one thing you can do is you can look for investors that sit in the insurance, or that have a core business in logistics, or that are in healthcare in some shape or form. Those investors tend to have an interest specifically in those verticals. And you can say, hey, look, we have 4 or 5 portfolio companies that are in this space. They have new innovations. You can work with them as a corporate. You have a lot of alliances that you can build. So that's kind of one way of convincing these investors. I think, if we look at sort of COVID-19 and where we are now, you have to do a bit of extra work. They also want to understand that, okay, fine that you have all these companies, but those are risky investments. Will they be able to survive these next 12 months? What are you doing to help them out? Do I need to put in more capital? What is the risk on valuations? Are we paying too much, or have we paid it too much in previous rounds? So it's very much a strategy of seeing or showing what your portfolio strategy is, how you've been able to manage it, and how you're able to add value to their core business. For financial investors, it's more around showing your track record, showing your performance, and how you are driving liquidity over the years.
It's actually an interesting time right now for VCs and the due diligence you have to carry out into these smaller investments and how much pressure you get from your investors to carry out that due diligence. Because just before COVID, we had the WeWork and SoftBank issues. And I understand that you got put under quite a lot of pressure from that, plus the COVID-19 now.
Yeah. It's been it's funny. I think someone told me yesterday we can get a break, and I guess this is definitely part of it. What we saw last year was a tendency towards, we want companies to show that you are able to become profitable in the next 2 to 3 years. So the years of plowing money into companies and saying just go for market share and market share is everything, it feels like those days are over. It is now more around, okay, are you able to really execute in building a sustainable business? And at some point in time, when the music stops and there's no new capital to deploy into these companies, are you able to still run your company, and are you able to grow and become profitable? I think COVID-19 will accelerate those discussions because, we might have institutional investors that decide, for the next 6 months, I'm going to hold still. I want to sit on my cash and not invest. You have to think through, what does it mean for me as a company? And we're thinking through, what does it mean for us as investors? And one of the things you need to do is really think about, yes, in some shape or form, you might have to cut costs. You might look at your monthly burn. You might need to think about, okay, maybe we can, instead of being profitable in 3 years, become profitable in 2 years, or maybe even 1 year.
COVID-19 has put the world economy under pressure, and investors are looking to where to invest their money, if it's in safe havens like gold traditionally is, or into other equities, or even be it tech companies that should be profiting from this. How do you deal with your portfolio companies and your investments, and where are you looking for your next investments?
So we do a lot of work in defining or finding new trends. So I can give one example. A few years back, we were, as an industry, very much looking at what's happening in the e-commerce space, or what's happening into the commerce marketplace space. And the interesting part is, if you look at SEC at these companies, you might decide, okay, I want to invest in an e-commerce company, or I want to invest in a marketplace. But there are underlying infrastructure companies that are service providers. Think of payment gateways. Think of last mile logistics. So besides logistics or e-commerce or fintech, we started investing a few years back into, for instance, into healthcare. We started investing into education. As there's more disposable income in this region, again, COVID or no COVID, at some point in time, people need to be spending again, and we want to be prepared for that. If people are interested in giving their kids better education, ad tech or education tech, it would be an interesting industry to be investing in. If you look at consumption, think of agriculture, where how do you bring food from farmer to the retailer? So we keep on analyzing these different industries and see whether we're able to find anything that is beneath that surface that other people don't see.